Joining us at Post 9, Goldman Sachs Chief U.S. Equity Strategist David Kostin. David, welcome.
Thank you.
Do the events over the last, 48 hours change your opinion of where the market's headed?
Well, no. The forecast for the S&P 500 remains 3,100 at the end of the year. That's about 9% above where we are now. If we frame what's happened at the start of the year, the market was trading at around 14 times forward earnings. Peaked last month at around 18 times forward earnings. And so almost all, 95% of the return of the market this year has been or was driven by valuation expansion as opposed to something more fundamental like earnings. And so put that in context, we've had a 6% decline in the market. It's an adjustment in valuation as opposed to something more fundamental. So I would argue that the general thrust of what's taking place fundamentally is still pretty much in line.
What's an appropriate multiple, though, given the very least increased tensions with China, the possibility this is going to drag on for quite some time?
That's our basic assumption, that that's going to continue. But the question is, what's the appropriate multiple in a 1.7% 10-year U.S. Treasury yield environment? And we have risk premium now is the highest it's been, way above the long-term average, almost 400 basis points. Think about 10-year Treasury yields at 1.7%, and you look at the earnings yield of the market at 5.7%, it's like 400 basis points. That's a very wide relative to history, which is probably 250 basis points or so historically. So there's definitely a risk on the trade and the tariffs, et cetera.
Has that move in Treasury surprised you?
It has, in terms of the swiftness and the magnitude of the decline.
I mean, we were 2.07 right before the Fed cut last week, a week ago.
Correct. And of course, I always say to clients, it's difficult to model President Trump. And so we had the Fed cutting rates, which is a good thing, from an equity market, equity friendly, if you will. And the next day, 24 hours later, there was a tweet about tariffs. And so that makes it a little more challenging, obviously. So what are we focusing on with clients right now is a couple of strategies. The first is services compared with goods. So services providing companies as opposed to goods producers. And that is an important dynamic. In fact, I was on this program a couple of months ago talking about as a strategy. And the reason for that is that the companies that are services providing are more domestically facing. They don't have as much exposure from a tariff point of view. They happen to have better growth in terms of earnings, and they trade roughly at the same valuation. So if you think about some of those companies, Microsoft, the top of the list, Amazon, with Google as examples. Another strategy would be companies that are more domestically facing in terms of their source of their revenue. So some of the payroll processors, ADP, Paychex, those
small
companies.
caps have underperformed.
Small caps. Well, that's correct. The question is about what's happening exactly on the sort of trajectory of the economy. Some of the larger companies maybe have more durable business models, more stable gross margins. And that's something in this environment where we have a lot of uncertainty, that's pretty attractive for companies to find, as investors, to find companies with those attributes.